Measured in tonnage, silver represents a marginal fraction of global financial assets, yet it intersects simultaneously with industrial supply chains, monetary reserves, and strategic trade settlement mechanisms. Annual mine supply fluctuates within a narrow physical range, while demand vectors increasingly originate from systems that are not price-driven, but policy-driven. This analysis reconstructs how recent state-level actions have introduced a structural contrast between paper-based price discovery and physical allocation that no longer converge under previous assumptions. In the first quarter of the current year, both Russia and China implemented documented adjustments to their domestic silver frameworks. Russia expanded state procurement channels tied to strategic metals, formally integrating silver alongside gold within specific reserve and industrial classifications. China, in parallel, modified import, refining and exchange-related mechanisms affecting how silver flows between industrial users, state entities, and export-linked manufacturers. These measures were not announced as market interventions and were not framed as price-oriented actions. They were administrative, regulatory, and procedural, each traceable through public directives, customs data, and institutional disclosures. No single announcement altered global pricing immediately. Instead, the significance lies in the synchronization and directionality of these actions. At the same time, reported withdrawals from major Western silver vaulting systems increased, while registered inventories linked to futures settlement mechanisms showed continued compression. None of these movements violated existing rules. Deliveries were executed within contractual frameworks, and reporting remained compliant. Yet the aggregate effect revealed a shift in behavior. Fewer ounces remained available for discretionary circulation, and a larger share moved into systems where liquidity is structurally constrained by policy rather than market incentives. From an administrative perspective, global metals markets continue to function normally. Exchanges remain open, contracts settle, and industrial buyers source material without visible disruption. Pricing curves still respond to macroeconomic indicators, interest rate expectations, and currency movements. There is no declared shortage and no formal emergency. This apparent stability is central to understanding the current phase, because the systems involved are designed to mask structural divergence until reconciliation is no longer mathematically possible. The central question is not whether silver is scarce in absolute terms, nor whether its price should be higher or lower. The question is whether the same unit of silver can continue to simultaneously satisfy the requirements of industrial throughput, sovereign stockpiling, and leveraged financial representation without introducing friction between those layers. This analysis does not assume intent, coordination, or confrontation. It examines whether the observed configurations remain internally consistent. This report operates within clear limits. It does not offer forecasts, price targets, or strategic recommendations. It does not assign motives or imply misconduct. It documents observable mechanisms and evaluates their structural compatibility over time. Following the initial administrative changes, Russia's procurement mechanisms began channeling domestically sourced and imported silver into long-duration holding structures. These structures are not optimized for market responsiveness. Once allocated, material is removed from rapid circulation, similar to how strategic industrial inputs are treated under national planning frameworks. The volumes involved are modest relative to global trade, but they are persistent and cumulative. Each procurement cycle reinforces the previous one, creating a one-way flow that does not naturally reverse under price signals alone. China's adjustments function differently but converge structurally. By refining how silver is imported, processed, and redistributed within state-influenced industrial clusters, China reduces its exposure to external spot markets at the margin. Silver entering these systems is immediately assigned an industrial or strategic function. The metal does not reappear as exchange liquidity unless surplus conditions exist, which increasingly depend on policy thresholds, rather than market clearing prices. These actions occur against a backdrop of declining ore grades, rising extraction costs, and silver's dependence on base metal mining economics. Silver supply does not scale independently. It is a byproduct constrained by the production decisions of copper, lead, and zinc operations, which themselves respond to separate demand cycles. This creates a rigid supply profile that cannot easily respond to incremental policy-driven demand without time delays measured in years. The framing question emerges naturally from these conditions. If physical silver is progressively allocated into systems that are insensitive to price-based incentives, while financial representations of silver continue to expand within leveraged and derivative-based markets, at what point do these representations lose functional equivalence to the underlying metal? The question does not presume failure. It asks whether equivalence can be maintained indefinitely. Historically, global commodity systems tolerate long periods of divergence between physical and financial layers. These divergences are managed through rolling contracts, inventory accounting conventions, and confidence in future availability. What distinguishes the current configuration is that a growing share of physical silver is transitioning into domains where future availability is not guaranteed by price, but by policy decisions that operate outside traditional market feedback loops. From a historical and geopolitical perspective, silver has repeatedly occupied a dual role as both industrial input and monetary substrate. In periods of systemic transition, states have tended to reassert control over such dual-use materials, not as speculative assets, but as stabilizing components within broader strategic frameworks. This does not require overt coordination between states. It emerges from similar constraints, producing similar administrative responses. The structural model that follows traces this process through successive stages. Initial administrative adjustments appear neutral and limited in scope. Over time, they alter flow patterns. Those altered flows introduce asymmetries between physical availability and financial claims. Asymmetries persist without incident until a triggering condition forces reconciliation, not through intent, but through arithmetic. At the base level, silver's annual supply is finite and slow-moving. Demand layers are additive rather than substitutive. Industrial demand does not disappear when monetary demand increases, it competes. When state procurement enters this equation, it does not behave like private investment demand. It does not exit on drawdowns, and it does not rebalance dynamically. It accumulates. The mathematics of this configuration do not indicate imminent disruption. They indicate increasing sensitivity. Each additional constraint reduces the system's tolerance for shocks, whether those shocks originate from industrial surges, logistical disruptions, or changes in settlement behavior within futures markets. The system remains stable until it does not, and the transition between those states is not linear. This analysis will continue by situating the current developments within longer historical cycles of metal allocation, state behavior, and market adaptation. It will then model the structural stages through which such systems typically progress, followed by a quantitative examination of why certain reconciliations become impossible without systemic adjustment. The final sections will outline observable signals to monitor, not as predictions, but as indicators of which pathways are being reinforced over time. For now, it is sufficient to recognize that the global silver system is not experiencing a crisis. It is experiencing a reconfiguration. The significance of Russia and China's actions lies not in their scale, but in their direction, persistence, and insulation from price-driven reversal. These characteristics, once embedded, reshape the boundaries within which global silver dynamics can operate. To understand why the current adjustments matter, it is necessary to place them within longer historical cycles in which metals shifted roles inside global systems. Silver has never belonged exclusively to a single function. Across centuries, it has oscillated between monetary reference, settlement medium, industrial input, and strategic reserve. What changes from cycle to cycle is not the metal itself, but the hierarchy of systems competing for it. During periods of global integration, silver tends to behave as a throughput material. It circulates rapidly, supports trade, and remains largely invisible as a strategic object. Market pricing dominates allocation, and inventory turnover is prioritized over long-duration holding. This configuration assumes that supply chains are stable, geopolitical fragmentation is low, and that future availability can be reliably inferred from present price signals. In contrast, during periods of systemic fragmentation, silver is progressively reclassified. It becomes less a commodity of exchange and more a component of resilience. States do not announce this shift explicitly. Instead, it appears through administrative decisions, classification changes, and procurement logic that treats silver similarly to other strategic inputs. The transition is gradual and often unnoticed until the cumulative effect becomes measurable. The current environment exhibits several characteristics consistent with such a transition. Global trade is increasingly segmented. Supply chains are being regionalized, settlement mechanisms are being reconsidered, and exposure to external price-setting hubs is being reduced where possible. In this context, silver's dual-use nature becomes structurally problematic. It cannot simultaneously remain a just-in-time industrial input, a deep and liquid financial proxy, and a strategic reserve without internal tension. The first stage of the structural model is reclassification. Silver is not removed from markets, but its administrative identity changes. It begins to appear in policy language alongside materials associated with long-term planning rather than short-term consumption. This does not alter headline demand figures, but it changes who holds the metal and why. Holders motivated by continuity behave differently from holders motivated by return or liquidity. The second stage is flow redirection. Once reclassified, silver flows into channels that are not optimized for resale. State-linked procurement, industrial pre-allocation, and internal stockpiling all share a common feature. They reduce optionality. Material entering these systems is not intended to respond dynamically to price fluctuations. It is intended to remain available for predefined uses under uncertain future conditions. The third stage is asymmetry formation. Financial markets continue to expand representations of silver based on historical assumptions of availability and substitutability. Contracts roll, leverage accumulates, and notional exposure grows. This expansion is rational within its own framework because past behavior suggests that physical supply will appear when needed. However, the physical system has changed. A growing portion of supply is no longer governed by those assumptions. At this point, no contradiction is visible. Industrial users source metal without interruption. Futures markets settle, prices fluctuate within familiar ranges. Confidence remains intact because stress has not yet been applied. Structural divergence does not announce itself through volatility. It accumulates quietly through balance sheet and inventory composition. The fourth stage involves sensitivity amplification. As buffers shrink, the system's tolerance for shocks declines. Shocks do not need to be extreme. They can take the form of localized industrial surges, transportation bottlenecks, regulatory changes, or settlement preferences shifting marginally toward physical delivery. Each shock is manageable in isolation. What matters is their interaction with a system that has lost redundancy. This is where the mathematics of scarcity begin to matter. Silver supply is constrained not only by geology, but by economics and time. Because most silver is produced as a byproduct, increasing supply requires increased production of other metals, which may not be justified by their own demand conditions. This decoupling means silver cannot respond elastically to its own demand signals. The supply curve is structurally inelastic over relevant time horizons. On the demand side, industrial consumption is relatively non-negotiable. Technologies that rely on silver do so because of its physical properties. Substitution is possible only at the margins and often with performance or efficiency trade-offs. Once deployed, industrial demand tends to persist. Strategic demand behaves similarly, but with even lower sensitivity to price. It is driven by planning horizons rather than quarterly optimization. When these demand layers stack, they do not offset each other. They accumulate. Financial demand, meanwhile, is additive in notional terms, but relies on the assumption that physical reconciliation is rare and manageable. The system functions as long as that assumption holds. The question is not whether reconciliation will occur, but whether the conditions under which it occurs remain benign. Historically, when such systems approach their limits, adjustment does not happen uniformly. It concentrates at the weakest interfaces. These interfaces are often settlement mechanisms, inventory classifications, or regulatory definitions that were designed for a different scale or purpose. Adjustments at these points can be technical, procedural, and legal rather than dramatic, but their effects propagate through the system. The inevitability implied by this model is not directional in price terms. It is structural. A system that relies on elastic assumptions in an inelastic environment must eventually adapt. Adaptation can take many forms: reduced leverage, altered contract specifications, increased premiums for immediacy, or greater segmentation between financial and physical markets. None of these outcomes require crisis narratives. They are administrative responses to arithmetic constraints. At the current stage, the global silver system appears to be transitioning between asymmetry formation and sensitivity amplification. The actions taken by Russia and China are not sufficient on their own to force adjustment. Their importance lies in signaling a broader pattern in which physical silver is increasingly treated as a strategic input rather than a residual commodity. This pattern, once established, tends to be reinforced by similar decisions elsewhere, even without coordination. The next phase of this analysis will formalize the mathematical boundaries of the system. It will examine supply rates, inventory turnover, and claim structures to illustrate why certain equilibria cannot be maintained indefinitely under current conditions. It will also outline how systems typically respond when confronted with such constraints, not as predictions, but as documented pathways observed in previous cycles. For now, the essential point is that the global silver market is no longer governed solely by price-mediated exchange between willing buyers and sellers. It is increasingly shaped by administrative allocation, strategic withholding, and structural inelasticity. These forces operate slowly, but once embedded, they define the limits within which all other dynamics must operate. As the system progresses beyond sensitivity amplification, the final stages are governed less by behavior and more by arithmetic. At this point, intent becomes irrelevant. What matters is whether the quantities represented within the system can be reconciled under plausible operational conditions. This reconciliation is not hypothetical. It is embedded in settlement rules, delivery mechanisms, and physical constraints that already exist. The advanced stage of the structural model is convergence. Convergence does not imply collapse or resolution. It describes the narrowing of pathways available to the system. As physical silver becomes increasingly allocated into long-duration uses, the remaining free float must support a growing number of claims, transactions, and expectations. This concentrates pressure on a smaller and smaller base. The system continues to function, but it does so with reduced degrees of freedom. At this stage, even modest changes in behavior can have outsized effects. A marginal increase in preference for physical settlement, a localized supply interruption, or a regulatory adjustment affecting inventory classification can force rapid rebalancing. These rebalancings are not discretionary. They are mechanical responses to mismatches between obligation and availability. The mathematics underlying this condition are straightforward. Annual mine supply enters the system at a fixed rate. Recycling contributes an additional but limited flow. Against this, cumulative demand layers draw down available inventory. Financial representations multiply exposure without consuming metal, but they assume that metal exists as a backstop. When the ratio between claims and deliverable inventory exceeds certain thresholds, the system's stability depends entirely on confidence that delivery will not be broadly requested. Confidence is not a sentiment. It is a structural property derived from past outcomes. As long as delivery requests remain rare and manageable, confidence persists. When delivery becomes more frequent, even if still a minority behavior, confidence must be actively managed through procedural adjustments. These adjustments may include cash settlement incentives, altered contract terms, or administrative discouragement to physical withdrawal. Each adjustment preserves functionality but also signals constraint. The closing logic of the model shows that the system does not fail because silver runs out. It fails if it is required to perform mutually incompatible roles at scale. Industrial systems require certainty of supply. Strategic systems require insulation from volatility. Financial systems require liquidity and leverage. A single physical stock cannot indefinitely satisfy all three without segmentation. Segmentation is therefore the most probable outcome of structural closure. Segmentation does not require formal declaration. It emerges when different classes of silver begin to trade under different rules, premiums, or access conditions. Physical immediacy acquires distinct value. Long-duration holdings become effectively invisible to markets. Financial representations continue, but with altered assumptions about conversion. Looking forward, the relevant horizon is not a date, but a sequence of observable conditions. One condition is persistent divergence between reported inventories and actual availability for withdrawal. Another is increased administrative attention to strategic metals classifications. A third is the gradual normalization of policy-driven procurement as a permanent feature rather than a temporary response. None of these conditions imply crisis. They imply adaptation. It is also necessary to consider counterpoints. Technological substitution could reduce silver intensity in certain applications. Recycling efficiency could improve. New mining projects could come online. Financial markets could voluntarily reduce leverage or exposure. All of these factors would increase system tolerance. The model does not deny them. It incorporates their timescales. Most operate over years or decades, while allocation decisions operate immediately. Another counterpoint is that global coordination could re-expand liquidity by reclassifying strategic holdings back into market circulation. This would require a reversal of current incentives and constraints. It is possible, but it is not costless. Once material has been allocated for resilience, releasing it reintroduces exposure that the original allocation sought to remove. The future timeline, therefore, is best understood as a monitoring process. The system will signal its own boundaries through administrative changes, settlement behavior, and inventory dynamics. These signals will be technical rather than dramatic. They will appear in footnotes, rule updates, and reporting conventions. Observing them requires attention to structure rather than narrative. The role of Russia and China in this context is illustrative rather than singular. Their actions demonstrate how large systems respond to similar constraints in parallel. They do not need to coordinate to produce convergent effects. Structural pressures guide behavior toward similar solutions. Once these solutions are implemented, they become part of the baseline that others must adapt to. In closing, the global silver system is undergoing a transition from a predominantly market-mediated allocation model to a hybrid structure in which administrative and strategic considerations play a growing role. This transition is gradual, procedural, and largely invisible to price-focused analysis. Its significance lies not in what it promises, but in what it constrains. This analysis does not conclude with an outcome. It establishes a framework for observing compatibility. As long as physical silver remains capable of reconciling its industrial, strategic, and financial roles without friction, the system will persist. When reconciliation becomes arithmetically constrained, adaptation will occur, not by choice, but by necessity. The appropriate response to such a system is not anticipation, but comprehension. Monitoring flows, classifications, and settlement mechanics provides more insight than focusing on volatility or narrative. The system will reveal its direction through structure, not through declarations. This concludes the reconstruction of how recent state-level actions have altered the boundary conditions of the global silver system. What follows is not a prediction, but an ongoing process of alignment between physical reality and systemic representation.